Hello, I'm Nathan. He's Lauren, and you are watching your November 4Thought. Did you like the dramatic pause?
I did.
Added that in.
Yeah.
I've been watching a lot of playoff baseball.
So
and that was my
the
change-up.
pause.
That was my change-up.
I heard it.
It's off speed. Okay, you know what that is?
Pattern interruption, I think
Yeah,
is what they
I was
call
trying
it.
to do that. It's a beautiful fall day in our offices in the north suburbs of Pittsburgh.
Yeah.
And
Obviously, it's a Friday because we have our fun
yeah, and it's a
outfits
Friday.
on.
That's right. I mean, we're not exactly matching vibes, but you're casual. It's casual. I like it. We're not fully like, you know.
This is casual for me.
I heard that vests were appropriate for a Friday casual wear. So I said, I'm doing it. I feel, and in my old age, I get chilly.
That's what it is, yeah.
I get colder. I used to run hot. Now I'm like cold.
You can tell when the weather's going to change just by it's in your bones.
Yeah, something.
You don't have to worry about
I feel
watching
cozy in
looking
this.
at the weather app.
I feel great. And if you're watching this, you're one of a very exclusive club. That is Lauren or Nathan's clients, or you are interested maybe in becoming one of our clients, or at least learning more about our investment philosophy, the services that we offer at the firm, etc. So if you're one of those groups, you're in the right place.
And we want to say thanks for joining us.
Thank you very much. So for the next 15 or 20, depending on how much he wants to talk,
So 20
you're in the right place. Yeah, so thanks for joining us. So what are we going to talk about? Speaking of that, what do we want to talk about today?
I think I have so much on my mind, and just like Nathan says, I'll ramble on forever. So I did try to organize it more than normal.
I think it's good.
On paper.
You went through before, it looked good.
Yeah,
this is great. You're going to move it along.
Like we always say, if you're just watching the video, we also put out a newsletter, and the newsletter may or may not completely coordinate with the video, but I think this month it was important that we wanted to not necessarily reiterate what the newsletter is written about, but maybe expand upon it, add some commentary to it and some insight. And maybe some specific examples of clients and situations that we've gone through, that we've been talking to about, and what those people's concerns were. So again, if you haven't watched all of our videos, Nathan and I are meeting with clients all the time. We do try to gather what their questions or concerns are, because we figure if those people have those concerns, maybe a broader market does too.
Yeah, so we wrote about, tempering expectations. And I think it's an appropriate time to go deeper into that for the video, because, this is the third year. I mean, we're in November here, so like 23, 24, now 25 of good performance, great performance. I mean, in the S&P 500, I just read the statistic that from January of 23 through like essentially today, we're filming of this, we're up about 60% in the S&P 500. That doesn't mean everything you own is up that way, but that's a good indicator of the broad market, and it's up pretty substantially. So roughly 21% annualized return. Yeah, that's well above a long-term average. Right?
Yeah. We don't want to call it abnormal performance, but we want to call it above trend performance. Right. And like anything that you've ever heard or talked about, no abnormal trend can last forever. There's always a reversion to the mean. Right. Do we know when that's going to happen? No. I mean, we're filming this in October, which is traditionally a market in which you have some additional volatility for lots of reasons. If Nathan lets me, I'll talk about that later. Sure. But there's definitely a lot of chatter going on. Used to be, in April, it was about tariffs. Mm-hmm. Now it's about trade wars. Or it's about regional banks, or it's about, I think the point is there's always going to be a reason not to invest or not to stick to your plan. Mm-hmm. So I thought we could talk a little bit about, when those circumstances happen, when there is a market revision, correction. Mm-hmm. Fancy ways of saying the market goes lower. Yeah. Right? So if you have assets in the stock market, you're going to see that asset balance reflected at a lower price on your statements and online. And usually those don't last for a very long time. It could be weeks, months, quarters. They usually don't last years. They can, but they do happen, right? Yeah. So they happen almost annually. And we had one earlier this year. And you were mentioning, earlier. Yeah, we had and hopefully, the firm itself sent out a communication to everybody. We try to reach out to as many people as we could. Obviously, we put it in our newsletter as well and the video. But April was a very significant pullback. I would call it a correction. I think it hit that. Oh, yeah, almost what they call a bear market. So S&P was down peak, which means the top earlier in the year before down to the trough in April was down 19%. So it was a pretty big drawdown in stocks. Yeah, I think it was. And a big mystery, a big unknown, which makes it even worse. When you kind of have a fundamental issue And again, we're filming this when there was just a recent news headline about regional banks, that there were some fundamental issues about easing of credit and are the restrictions on credit appropriate. That's different than when you have a geopolitical kind of conversation that is open-ended and nobody really knows where it's going to go. So those people that suffered that pullback in their portfolio, if they stuck to the plan, I think they, and that it was so short term that reward probably maybe wasn't short term enough for a lot of people. But I think the rebound happened so quickly.
It did.
That maybe some people didn't even realize how severe it was.
Yeah, and I think sometimes, if you're owner of stocks, which most of our clients are, and you're in some sort of pullback period, sometimes it happens. It seems like first off, it seems like they happen quicker and quicker in terms of the peak to trough time. And then not only the peak to trough time, but then the turnaround to get back to kind of, okay, well, now stocks have kind of found their footing and they're going to move higher again. And we know, over time, over long periods of time, stocks have an upward bias, we like to say. So assets in the future are going to be worth more than they are today. But, I'll let you talk more about that if you want. I was just going to say that, sometimes it happens so fast that people, even if they wanted to or thought they should do something about it, it happened so quick they didn't. But in retrospect, it's probably a good thing to do nothing most of the time. Why is it a good thing to do nothing? Because you've probably, if you're working with us, you have a plan, you have a portfolio that we're helping you with. You don't want to necessarily disrupt that plan or portfolio just because it's down 10 or 15 or sometimes 20%, unless maybe there's a tax reason to do so.
No, I think you highlighted exactly what I was going to reference is if you have a hodgepodge portfolio that, you didn't have a cohesive thought process behind it. Maybe, hey, I had a retirement plan here 15 years ago. I just left it behind. Yeah. I haven't looked at it in a long time, or I heard some hot stocks, in the gym locker room and I bought those.
My next door
neighbor,
brother-in-law.
And
no offense to my brother-in-law.
In that category, I think, a market pullback maybe opened your eyes to the fact that, hey, maybe this is something I should be more aware of. Maybe this is something that should have a plan behind it. And if it doesn't, maybe there would be additional reasons for concern.
Yeah, and I see on here you have managing emotions. And I think it's easier to do that if you have a more diverse portfolio that you're saying, okay, I'm not just going to own the S&P 500. And we reference the S&P 500 because it's a great way to track the market over a very long period of time so we can get that data or data, however you like prefer to say it. But that's not really what our clients are owning, because right now there's an extreme concentration in the S&P. So if you owned just the S&P 500 index and you took the top 10 companies out of that 500, they represent over 40% of the index right now. So you're really concentrated around those companies, and the portfolios that we're investing that are the engines for our clients that are taking them down the road to wherever those life plans are down the road. That's not necessarily the engine we want that's driving them there, because if you're owning something that concentrated, eventually when a correction does come, you're going to feel that really sharply. And then that's going to probably trigger some emotions or make you emotional about things in your portfolio and maybe cause you to do some things that you wouldn't rationally do or otherwise do.
Yeah, I think, we're talking a lot to our clients. So I think they have a lot of this information at their fingertips. We just did the seminar series where we got to talk to people in person. Everybody that came to that didn't just get to see us, but they got to see the firm leadership and the thought process behind the portfolios and how they're built. I thought that was really helpful, because what we're probably talking about is what you're hearing out in the ether about, hey, just buy the S&P 500 and forget about it. I think there is a rationale maybe in the past of how that provided a basic diversified portfolio, at least of U.S. companies for large capitalization. But is that a robust portfolio now for someone with no international exposure, no, maybe they're in
small and mid caps or et cetera, and those other indices, they aren't as concentrated.
Perhaps. Yeah, and I say, just like you highlighted, now the concentration is in large cap growth. So when you're buying the S&P 500, is that really what it was 10 years ago?
Right.
So I think that was important. Nathan mentioned earlier, and I have some statistics here so I don't mess it up, but I did want to talk a little bit about market cycles.
Sure.
I want to put some emphasis on that point. So on average, bull markets last over 4 years with roughly 150% returns, while bear markets last less than a year with losses around 32%. So I think knowing that kind of helps frame volatility. I think for our clients that have been with us since we came to Confluence, you already experienced that. I think
a lot of volatility in the last 5 or 6 years.
I think a lot of people, hindsight's 2020. In 2020, 2022, you had a double-digit down year in the marketplace,
and bonds,
right?
So
you
it
really
didn't matter,
had
right?
the perfect storm, and this isn't always the case, but in 2022 and even in the April pullback, if you had cash on the sidelines, maybe that actually presented some opportunity to kind of look at your portfolio. If you weren't fully invested for whatever reason, that could have been a good idea. So I think not in every circumstance, but I think if you see a market pullback and you see it as an opportunity to provide additional opportunity for your portfolio, or maybe you haven't had the ability to consolidate your portfolio into a cohesive plan, that's a good time to look at it. So I wanted to just talk about that. I think we talked enough about concentration and diversification. You talked a little bit about investor psychology, and we've done a million videos on these. So I don't.
One of our favorite topics.
It is really one of our favorite topics because it's in everything. So Nathan just got back from a mountain bike trip. I was there, and that kind of proves why behavior is the most important thing. So Nathan's planned this trip out for 22 years. I know it's coming every year, and I'm never in shape enough to actually ride mountain bikes.
That's not true. You've ridden before. So sometimes.
So no matter what we do to create the ideal portfolio to achieve someone's hopes and dreams, so I try to make those come to reality, we can't control their behavior. And that has such a much more impactful process on the portfolio. So if we put together a portfolio and someone has a panic reaction, or on the opposite, someone says, hey, like you mentioned, my neighbor or someone told me that I should be getting
I'm going to chase these returns. I think humans are I just read this and I think it makes a good point. Like if apples went up threefold in the last year and a half, I bet people would probably choose a different fruit or stop buying those apples. But if a stock went up threefold in the last year, it seems like, are we avoiding that in the same way? No, I think more people want to own that, which may in fact push that price artificially high, which eventually is going to correct, right? So we have humans have just a different tendency around investing than they do in a lot of areas of their life.
Because it's recent history. Our animal brain was built for a totally different environment than our Spock brain, as I like to say.
And if you pull emotion out and you become more rational in your decisions, which is hopefully our kind of role in helping you get to where you want to be. If you pull emotions out, you're going to avoid a lot of pitfalls and mistakes. It's not really about, the longer you invest, I think this is kind of comes more apparent. It's not really about hitting a home run every time you hit the ball.
It's about consistency.
It's about consistency. And I relate it to maybe to tennis. I don't play as much as I used to. I used to play a lot when I was younger. I don't play as much. But I know, like, if you're a high performance tennis player, you're winning with your serve, your accuracy, you're painting all the lines. If you're 99% of everyone else, it's about avoiding the double faults. It's about avoiding mistakes, hitting it into the net. If we can help our clients avoid the big mistake and just keep them on the track, keep them in the game, that's going to get them to where they want to be.
Yeah, it's funny. One of our coworkers is a tennis instructor, and we just talked about this, how
he would know.
Yeah, your dream is to let your opponent make the mistakes that you don't make.
Right.
So that's what not that you want other people, investors to make mistakes. We don't want them to make mistakes.
But we know that they do.
But we know that they do, and that's what we're trying to help people avoid. So I think that was good. Volatility is inevitable. Emotions are inevitable. So we want to try to figure out how we can connect those things together to help limit costly mistakes that normal thought process and emotions that the 24-hour news cycle loves to kind of trigger doesn't ruin your chances of success.
Yeah, I hear you say the 24-hour news cycle, and I just had a meeting before this morning with a client who called me because he had heard something on the news. So I think we can remember, depending on how old we are watching this, some of our clients are much younger than we are, but 15 or 20 years ago, I feel like it was, you watch news, it was on a local level, you read a paper on a local level, then it became more regional or national, and the chances of you finding something terrible going on the local level are rare. And when you expand it out nationally, there's a bigger chance. And now it's international,
it's everywhere.
It's 24 hours, and it's social media as well. Yeah. So the chances of you being exposed to something that is unsettling, unnerving, makes you anxious, etc., it's 100% of the time. So just to kind of think about that and make sure you have perspective when you're consuming those things. And we say that a lot too, but I think it's important to say.
No, I think it's hyper important. And again, I hate to keep talking about our bike trip, but one of the best parts for me, and I felt such a relief, and I felt less anxiety about things, and I thought it was being out in nature, riding motorcycles through the mountains, seeing all the fall foliage. But I also remembered that as you go up to the Blue Ridge Parkway, you don't have any cell reception. You're not getting any notifications about anything, which
kind of nice.
Is kind of nice in the short term. So you still want to,
when your wife needs to call you about the kids. That's different.
That's a different circumstance, a different anxiety. So I did. I think we did an okay job. We'll have to make sure that we put some charts and graphs in here for those who like those things. We never want to get too much in the weeds, but we want to make sure that we're exposing people to the data that we're looking at to help us make those decisions. One thing Nathan said earlier before we kind of talk about some year end and some action items is, I think you highlighted it, that we do think there are areas of the marketplace that are overvalued.
Sure.
So we don't disagree with that. We're not a glass is always half full. What we think we're trying to help identify is value in the market. So, we do a rebalance in the portfolio. We have the capability to do tactical rebalances, but traditionally we're going to do our rebalancing in January.
Right.
So I think that's important. I also think what I said earlier, if people kind of have a hodgepodge or they don't know what they own, I think making sell decisions and there's no discipline to it can be very, very difficult. So I at least wanted to put that in there that, a market pullback oftentimes recalibrate the overvalued areas of the marketplace and allows us to kind of set the stage for the next growth cycle in whatever that next value.
Yeah, you weed the garden, you trim things back so they can grow further. And I think, when we're doing rebalancing or we're in constructing portfolios with our policy team here, and we're building something that is like I said, the engine that gets you kind of where you want to go, it's got to endure bad periods, right? And how is it better to endure that is making sure it's not, you're going to have uneven growth, right? You put a portfolio together in January and then now it's November and there's certain parts of that portfolio that's grown at a much rapid pace, more so than the others. And you want to make sure and rebalance that and make sure it's back aligned with your goals and the purpose and the reasons that you invest in the first place. Yeah. If you don't do those things consistently, right? And you don't do those things in a way that's more rational and you do things like more emotional, that's not a great thing, because emotionally you're going to want to keep that thing that's grown the most. And you're going to maybe even add to it. So we want to, again, reduce errors, reduce mistakes along the way.
No, I just want to say, to my clients, you heard me say this a million times, so has Nathan, so I'll apologize in advance. But if the perfect portfolio is corrected, you should have an asset class in that portfolio that's negative. Yeah. Because you've created the perfect portfolio. So the dream is you're going to have more components of the portfolio positive than the negative ones, but you can't, this isn't Las Vegas where we're betting red or black on what's going to do well and what's going to not do well. Right. We don't have a vision of the future that's perfectly clear. So we try to use data points to put together the ideal portfolio, again, for what it is you want to achieve. I hate to say for your goals and objectives because it sounds trite, but it is very meaningful. You have a different idea in your mind of what your life is going to look like in 5 years than I do, than Nathan does, than your neighbor does.
And it has nothing to do with what an index is doing.
Correct. We're not measuring against that.
Yep.
We're measuring against how you want to live, how your family wants to live, and how we can best get you.
Yeah, and then we have a plan that says in order to do those things that Lauren just mentioned, you need 6 and 6.7% annual rate of return, right?
Yeah.
And then how are we going to
6.66? Then you would freak me out.
Yeah, I was going to go there, but if then once we have that number, that's your number that you want to focus on. Okay, we're going to build and construct a portfolio and monitor a portfolio over time that's going to give you the highest likelihood of those type of returns with the least amount of volatility that might cause you to do something emotional about your portfolio. And these last few years where we've had well above average long-term returns, one of two things is going to happen. Yep. You're going to have a correction before the market kind of resumes its trajectory over time. That's probably the more likely scenario. Or you're going to have a slower growth period over time, which can happen too. If you have the correction, but though I think if you understand from our conversations with you that those are normal, they're going to happen and reoccur 10, 15, even 20% happens pretty regularly. And we just had one 9 months ago. So those things do happen. And when you view it through that lens, it probably provides you a little more comfort and, the knowledge that, okay, well, I've talked with Lauren about this. He said eventually this would come. We're not predicting when it happens.
No way.
This could actually go on, this growth period could go on for a lot lot longer. But when it does eventually, the likelihood of that correction occurring, when it does happen and you're armed with that knowledge, I think that's powerful to help you, as you said, stay the course, but also maybe even add more, allocate more cash from the sidelines or from other investments into that portfolio during that period of time. We can identify when everything is on sale in every other aspect, right? Except for when stocks are on sale. So I think it's just good to know that going in before you're actually in that moment. So now is the right time to talk about those things.
Yeah. And, when we talk about what that average rate of return is, 6.67 or whatever it is, you may never actually hit that rate of return.
Almost never.
And that's what I would say. In fact, you may never hit that rate of return.
Yeah. And the S&P's average rate of return, if we say it's 10%, it's almost never
hit that
10%.
number. So this, we have double-digit returns 3 years in a row, and then we revert back to the norm, whatever that is. That is normal. That's what I want to make sure people understand. It isn't a slow, steady up, up, up. It is, in the short term, it is volatile.
Yep.
In the long term, like you said, it is a mountain that you're taking steps on to go up. So with that being said, I think we've communicated a lot about that. We talked a little bit about year-end action items. One of those, even though it's not totally year-end, we do a rebalance in January. One reason we do that is some of our portfolios still have mutual funds. There is some legislation changing in that landscape. We won't talk about in this video, but we definitely will keep you abreast of that as changes occur. But mutual funds, by their prospectus, have to put out capital gain distributions. So as they're trading stocks or bonds or real estate or whatever it is that their investment policy statement states, if they made profits, which
they distribute them out to you and you pay the taxes, which is fun. And we want to limit the taxation on your portfolio because we know that's a drag on your results over a long period of time. So at this time of year, we're starting to get estimates in, right? We get estimates in. If you have mutual funds, here's what they're probably going to pay and distribute. And we're doing whatever possible in terms of tax loss selling. I mean, unfortunately, you're not going to have a lot of opportunity
because we've had so many good
because
years.
It's been a good period here. But you did have there was a period earlier this year that we've referenced multiple times where the market was down. And in that period, if you had taxable accounts where we thought there was an opportunity to do so, we would harvest those losses.
And same thing, if we do experience something before the end of the year and there's an opportunity to do that, we will.
Yep.
So, year-end things, obviously, what we're doing. At least we communicated some of that. If you want to know more about what we're doing, that's why we do these videos. Please reply. We'd love to talk to you about more about what we're doing. How about what you should be doing or you should be thinking? So one, I always want to make sure people have appropriate cash reserves. So sometimes when the market does really, really well, you get that feeling of exuberance, and maybe you have, it could be you put more in the market than normal. It could be that you have the wealth effect where you're feeling, very affluent because you have such a large 401k or retirement plan balance. So maybe you've let that cash reserve go down a little bit. Now's a great time of year to kind of revisit that.
Totally.
Same thing, revisit as anybody does at the end of the year. Hey, what did I not do this year that I want to do next year? So if you have something big coming up, maybe somebody's going to college, or maybe somebody's going to a more expensive college than you originally told us. Maybe you're selling your business. Any of those things that we won't know unless you communicate with us. Again, that's what we kind of ask. And the reason we do these every month is, let us know how we can help. So if there's personal changes going on in your life, let us know, and then we can kind of adjust the portfolio based on those. That's a good reason to change the portfolio versus what's going on with the market.
Yeah, instead of being trying to be predictive about when the next market downturn is, that's not a great reason to change your portfolio at all. But to make sure that, hey, if you have something in your life that's going to change, that's the reason that we want to make sure that you're objectively, like your objective-based portfolio is aligned properly with whatever your life objectives are, whatever you want to achieve over certain periods of time. So it's good that, we're doing rebalancing annually. We're touching base with clients, at least annually, often more than that. But if there is something that is coming up on the horizon that you think we should be made aware of, reach out, let us know so we can plan accordingly.
Yeah. So Nathan said we don't predict market pullbacks, but I'm willing to say, and maybe we'll put the Thanos snap in here, that market volatility is inevitable. But having a clear plan and hopefully people in your corner can make that less disruptive. So, the reason we put out these videos, the reason we put out these newsletters is we would love to hear back from you. So please get in touch. If you have any questions or concerns, or you're hearing things that you're unsure about and how those may have an impact on your portfolio, we don't have all the answers, but at least we have the data points and the information, hopefully to make you feel more secure about the plan that you put together and the path you're on for the future. And again, it's hard to believe it's already November, so I just say happy Thanksgiving. Please enjoy all the time you can with your friends and your family.
Yeah, happy Thanksgiving. Talk to you soon.